Okay, cool. All right, and we are live. Good afternoon, everybody. As always, we are here to inform you on some amazing things around real estate. And today we have Nicole Simons, and she is an insurance expert. And she's going to tell us a little bit about herself. Hello, Nicole. Tell us about
Hello,
yourself.
Amir. Thank you. Thank you for having me. So like Amir said, my name is Nicole Simons. I am a licensed insurance broker, and I work for my family business, CPN Financial Services. What's cool about my family business, actually, it was started by my dad over 30 years ago.
I remember you telling me this. Sorry to interrupt. The first time I ran into you was in Grand Valley. You had you had a booth. It was a few years ago. Must have been like 2018. But anyway, sorry to interrupt, but that was a really cool story.
Yeah. So I would like to share that. So my dad was an insurance broker, an investment broker as well, and he wanted to start his own firm. So he started his own firm and named it CPN Financial Services, and CPN stands for Colin, Peter, and Nicole. So I'm the N, and the C and the P are my older brothers, Colin and Peter. And we're a full brokerage house, kind of your one-stop shop. We do everything from, insurance, so life insurance, disability, critical illness, all the way over to investment. So we deal with RRSPs, RESPs for kids, TFSAs, all of that. So our job at CPN Financial is basically to build that financial fence around our clients. So in the event something happens like premature death, a critical illness or disability, that, their income is protected and that your family is, very minimally impacted.
Very cool. Very cool. So your wealth of information in this, and hopefully we're going to be able to bring a whole bunch of awareness to some of the amazing things that you do today, and hopefully help some other people in the process.
Yeah.
Very cool. Very cool. So we'll just dive right in, and we'll start with some of the things that are important. And this has sort of been something that I've started to think about more. And when you're a bachelor, and you don't really think about a lot of this stuff, but as time goes by, you have kids. I find it hard to go on roller coasters too. It's like anything risky is like, oh, that's a risk, but you don't think about insurance and like what's going to happen once you're not around, and nobody really wants to think about this stuff. But they could probably get hit by a bus tomorrow, and who knows, and then what happens. So obviously it's important to have some things in place. And I just wanted to ask you, what do you see? How important is life insurance to have for somebody, especially somebody that's self-employed?
Yeah, sure. So life insurance, is super essential for everybody, whether you're single, married, kids, no kids. It is the sound foundation for any financial plan, realistically, because, it's like you said, we don't really want to think about it, but at the end of the day, whether it's now by accident or when you're old and gray, we're going to pass away at some point, right?
Yes.
And especially if you're younger, when I say younger, under the age of 30 or 25, somebody has to pay for that, right? Whether that be, your parents or a loved one, significant other, burials aren't free. And over the past few years, maybe you can attest this, Amir, we've seen a lot more GoFundMe pages, being shared and spread around, crowdfunding to try and raise resources for burial costs. And that really wouldn't be necessary if people had, their own life insurance policy. So life insurance is a fantastic way to make sure that any expenses that have to do with burial are covered, but it's also a great way to create generational wealth and to ensure that the generations after you, have a great head start. So we can talk.
Tell me more about that one. So the other part, I'm not too excited about, but this one sounds pretty good. Generational wealth. Tell me more about this.
Yeah. So, I'm glad you asked, because I will say over the past 2 years, I've had a lot of inquiries, more younger people, I would say, than not, that are really interested in getting a life insurance policy. And when I say younger, I mean like early 20s, no kids, where before it used to be like, I'd have to hit a hammer over the head of why you need to get it. Whereas I feel like now, because financial literacy is becoming a lot more, important and it's a lot easier for people to get this knowledge, they're finding new ways and seeing benefits of getting life insurance early. So how generational wealth can be, used with life insurance, there's many ways, but more importantly, the death benefit that you get from a life insurance policy, death benefit would be the payout. So let's say, for example, 500,000. If Amir gets a policy for himself for 500,000, and heaven, forbid something were to happen to him, obviously, then if his wife is the beneficiary, which hopefully I'm sure she would be, then your wife can then use the proceeds from that policy to do various things. It can be used to pay off the mortgage so that, now your wife would be mortgage free. She wouldn't have to worry about paying that bill on her own. And then if there's any proceeds left after the mortgage is paid off, it can be used to cover plenty of things, any outstanding debt, cover education costs for the kids, fund a trust fund so that the kids can use this money when they're older. So it creates that extra resource for your family to use, at their disposal. So you can have certain wishes laid out ahead of time if you want to. But more importantly, Amir, the main aspect is that your family wouldn't have to be, worried about their finances while they're grieving their loss.
Yes, they're not scrambling to figure something out. And I wanted to really specifically, and this is why this is more for me, I think, but I hope somebody else finds this is interesting too. Say you have multiple properties, investment properties. Say you have 4, 5, 6 properties. Explain to us how that, if there's something out there, if you've seen a scenario like this where somebody's got these, and obviously they're taking care of everything, and all of a sudden something happens to them. Obviously they can liquidate that stuff.
Yeah.
But how can insurance help with something like that in terms of somebody that has a lot of investments and, all of a sudden they're not here?
Well, this goes back to the whole mortgage protection aspect, right? So life insurance is excellent for mortgage protection because, yes, like you just mentioned, if you have various income properties, your loved ones could liquidate them, if they need the cash or need the funds. But a lot of the times, we buy these assets because we want them to stay within the family. We want that wealth, real estate wealth, to be able to live on, to pass down these investments to our kids. But sometimes, that really can't happen unless there's funds to help with that. Because, if you have, a vacation property that you want to leave to your son or daughter, a lot of the times there could be taxes that have to be paid on that rollover to your kids. And if your kids don't have X amount of money to pay those taxes, well, then they're going to have to sell that asset that you worked so hard to, purchase for them. So having a life insurance policy for mortgage protection is key, because if the policy is big enough, it can, of course, pay the mortgage on the principal residence, but it can also either pay off the mortgages for your other properties, or at the very least, help give some taxable income to your kids so that they can pay any taxes to make sure that those other investment properties stay within the family.
Got it. So it sort of helps out to keep things afloat until you figure it out. And you said there's products out there that will cover multiple mortgages?
Yeah. So one life insurance policy, so one thing that I want to get clear, on our live today, because I know many people that you deal with will be impacted by this. So whenever you're purchasing a home, a lot of the times the mortgage company will approach you and ask you to get mortgage protection, right? And this mortgage protection is offered to you by the bank. So either the bank that you sign with, or maybe like a third party. But
I'll be honest. Sorry. I always say no to it.
Okay, good. So for those who don't know why Amir says no, I'm going to share some reasons why it's a good idea to say no. Now, don't get me wrong, having something is better than nothing, but I'm going to share a few reasons why having a separate policy, term insurance policy, is better than the one that the bank offers. So they're going to push and, ask for you to get coverage from the bank. And they're going to say, you're going to want to get coverage. So if something happens to you or your spouse, the mortgage is paid off. So you're going to think, yeah, of course.
And it's not cheap. It's not cheap. And it's like they recommend, and I'm not going to name my bank, but they really try to get you to do it. And these people aren't on commission. So I'm like, why are you pushing this so hard? But anyway, sorry.
They're on commission for it. Yes. And they'll try and tug at your heartstrings in regards to, you need to get this because what if? And it's true, because that what if could happen. But having a separate term insurance policy is better than the one the bank offers for a few reasons. And here's why. The number one reason is that when you're paying that bank monthly for that mortgage with them, mortgage protection, you're paying a declining balance. Remember, if you buy a property for $500,000 and now you're paying this, $60 a month for this mortgage protection, you're paying for a balance that is going down, every month, right? When you have a separate term policy for $500,000, you're going to pay, let's just say it's $40, depending on your age and how that's different. But let's just say it's $40. It's always going to remain $40, and the balance of $500,000 remains the same. So it's not declining. That actual purchase price or death benefit of $500,000 remains $500,000. Okay. So with the bank coverage, it's declining. With the separate policy, it's not. Number two, the beneficiary. When you have the mortgage from the bank, remember, they're the beneficiary of the policy, not your wife or anybody else. So if you were to pass away, they basically pay off themselves. So if your $500,000 policy is now only $300,000 and you suddenly pass away, they basically just pay the $300,000 off, that's remaining, but your spouse, your wife, or your husband is left with nothing, right? Mm-hmm. So the policy collapses, there's no further policy, and now your wife, yes, may be mortgage free, but what about the kids? What about the private school that they're in, or the RRSP savings that she was contributing to? Different things may still need to be funded. So when you have your separate policy now, remember, it stays $500,000. So now your wife can take that $300,000, pay off the mortgage, but she still has $200,000 left to do whatever she wants to help, maintain the standard of living, right?
Okay.
So that's option number two. Option number three, which is really important too, is underwriting. So underwriting has to do with the amount of questions that you're asked at that time of application. When you have the mortgage insurance with the bank, they ask you very little questions, maybe 5, 6, 10, maybe if you're lucky. And that's because the actual underwriting is done at claim time. That means that all the nitty-gritty investigation is done at time of death. And that kind of creates a lot of loopholes, or possibly they may not end up paying the claim due to something you might disclose at that time. But let's say your wife is filling out the application for the death claim, there could be loopholes there. When you have your term coverage, all questions are asked up front. So you go through a lengthy application process where they could ask for doctor's records and all of that. It's a little bit more time consuming, but the good thing about that is that all your health information is disclosed up front. So there's no little loopholes for insurance companies to try and, step out of, because they do their thorough investigation at the beginning and not at claim time.
Interesting. Interesting. Okay. Now, here's another question for you, and I've been thinking about this one. So somebody is self-employed and they don't, maybe they get hit by this bus, proverbial bus maybe, but they're still alive. They just can't work. Is there something that would cover them for that kind of stuff, where they just can't get up to go to work to do what they need to do? Is there something, because as self-employed people, we don't really get employment insurance that's sustainable, and if you did, it'd be enough maybe just to pay a quarter of your mortgage. And then what do you do? So is there something else out there for that?
Absolutely. So that Amir, would be disability insurance. So disability insurance is a type of coverage that self-employed people, it's a must. I'm a self-employed, like yourself, and I have it as well. I got that right away, like you said, because we don't really get other benefits that other employed people get, right? So disability insurance will give you a monthly benefit based on your income if you are unable to do the duties of your job, you're not working elsewhere, and you're under a physician's care, meaning that you've gone to a doctor, they've diagnosed you with something in regards to an illness or an injury, whether it be a broken leg or maybe some type of cancer. It doesn't even have to be that severe. But if you're unable to do the duties of your job, you're not working anywhere else, and you've seen a physician, you are able to make a claim. Now, this type of benefit is based on your income. So unlike life insurance, where you can apply for 500,000 or $1 million, disability is based on your income. So when you're signing up for, that type of coverage, your monthly benefit that they provide you will be based on what you make. So if you make 100K, a year, then, the percentage that you'd be offered is going to be based on that 100,000.
I see. It's how much you make personally, not how much your corporation makes or how much.
Well, we'll look at that. So self-employed people, when it comes time to the application, there'll be specific questions catered to us. How much do you make? Your net and all of that. Usually, they like to look at your 2-year net income, I believe.
Okay.
Just to see. So, but what's really, really cool about that, Amir, which you may not know, is that if you've had a really good, let's say, 2 years, let's say your past 2 years are great for income, there are particular plans for professionals that will lock in that amount, meaning that, let's just say if your next 2 years weren't as great, it's still going to pay the benefit based on those 2 fantastic years that you had. That rate will be locked in. So even if you stop being a real estate agent and you go work at Burger King, that benefit is still locked in and you'll still get that amazing income if you were to claim.
Very cool. Very cool. Okay. Let's switch gears from things that can kill us and name us to something else that's a little bit more fun.
Okay.
I love investing, and I, like a lot of other folks, do get that fear of missing out sometimes. And I wanted to sort of pick your brain and what you see right now and the times that we're living in terms of where we are in terms of the interest rates, and then the way the stock market's going and how volatile it is. What would you suggest for somebody that is a young professional, youngish like myself, and wants to do something with some cash that they got or something they can do recurring monthly? What would you suggest?
Yeah, great question. Well, like you mentioned, right now, things are very volatile. The stock market really hasn't been great over the past 6 months. And, that being said, it's made a lot of people become very risk adverse in regards to wanting to put their money into the market. But one of the main things that I tell people and tell, new clients looking to invest is this is a fantastic time to buy in. 100%. People that have their money already invested are feeling it. They've lost money and whatnot. But you have to remember that unless you're looking to cash out or redeem your investment, the losses right now are what we call paper losses. They're really not real.
They're not real.
They only become real once you actually say, Nicole, I want to take this money out of the market. When you opt to take your money out of the market, then you lock in your loss. Then it's real. But as long as this is money you don't need right now, you can leave your money in the market. And over time, you can see statistically with, charts and whatnot, that the market always does bounce back. How long it takes is up for discussion, but it always does bounce back. So going back to your question, if you're somebody that's looking to, get into investing, I think the first thing you want to pay attention to is what is your time horizon? Time horizon means, when would you need this money? Do you need it in 1 year, 2 years, 5 years, or 10 years plus? That's a really important factor, because if you're someone who wants this money because you want to invest because you want to have a down payment in a year and put money down on the house, not exactly the best thing to do. Investing to me is a long-term thing. And when you try to put your money into the market in hopes to get a great return in 12 months, it tends to not work in your favor. And considering right now the market is kind of on a slow decline, you can run into some real hot water if you need that money within a 12-month time period. So for people who need their money sooner, I would suggest you kind of keep your money out of the market, maybe in a high interest savings account or something like that. For people who have a longer time horizon that do want to invest, definitely a fantastic time to get in, because now you're getting everything on sale, right? All these top
That's right.
Your Googles, your Amazon, your Apples.
I saw Amazon's up today too.
Yeah, they're all at lows. And, people always want to get in when the company is doing well, but realistically, that's called buying at a high. You want to buy when they're not doing well, when the market's not doing well, because you want to be able to take advantage of that upswing when things turn around. So if you have a longer time horizon, I would suggest you open up maybe a brokerage account, or reach out to an advisor like myself that can give you some long-term options. But it would be a good time to invest for long-term. Okay.
And I don't know if you have any investment properties yourself.
Yeah, I do share a few with my brother right now.
Nice.
Yeah, my brother is really big into real estate. He has a lot of Airbnbs, in Canada and the US. So nice. I'm slowly learning, the tricks of the trade from him.
And how what would you say is how do you see that right now? So I obviously I know real estate and I like to invest in real estate. So um, are you guys actively investing in the real estate market right now?
I think it just depends on whatever deals come up. I mean, for me personally, we haven't bought anything within the last 6 months, but
Okay.
prior to things, doing that big downturn, we've always kind of been on the hunt for deals. And
Yes.
as you know, Amir, going on the outskirts further and further and further away
Yeah.
from the GTA has worked out well for many people. So that tends to be where most of our investment properties are. So my advice to people that are looking to possibly purchase something is always, contact and stay in contact with people, like Amir, real estate agents that can kind of give you an idea of where maybe the hot markets are and where there might be a downturn in, places that might have been expensive at one point and now there's been a shift. Because I'm sure you can attest to things have been dropping, right?
That's
So
right. And I'm the same way. I'm always looking for deals for obviously my clients and myself, but
yep,
obviously we put our clients first. So they usually get dibs on them, but
yep.
I get some too sometimes. But yeah, definitely. If you're looking for something like that, we have a few on the go usually. Now, if somebody doesn't want to invest so capital heavy, like putting money into a real property, is there something where there's a fund where a lot of people would put their money in? Is there something like that where somebody could invest in that and still be in real estate, but have invested with say a whole bunch of different people? Is there such thing?
Yeah, I think you might be leaning towards a REIT, which is the real
Yes.
estate investment trusts. And
Yes.
REITs essentially are a way that people can invest, within real estate without actually purchasing a home or a property.
Yes.
So REITs are basically different funds that you can invest in that have multiple companies in them. So,
Mhm.
for example, you can get a REIT that has maybe big box stores. So the owners like smart centers that have Walmarts and Home Depot and stuff like that. You can invest in REITs that have smart center and different big box ownership, for lack of better words.
Sure.
And that way you're not pigeonholed into one property. Essentially, you kind of have your money spread out. So
Yes.
yes, there are options for that, and that's a great way to diversify your portfolio as well.
And you recommend that maybe in a time like this, where say somebody's got a bunch of money sitting in the bank, and they're like, I don't want to buy a property right now because I don't know what's going on. I'll invest in something like this.
Exactly. Yeah. So maybe not put everything into REITs. Once again, a diversified portfolio is key. So everything from ETFs to some other type of stocks, some individual stocks and whatnot. But yes, that's definitely a more conservative way to have your money spread out amongst different companies versus just having it sitting in one, house that you may not be able to manage. You don't have the time to
Yes.
manage investment property or
And
have the
you can't
income.
liquidate it like that. It takes a few
Exactly.
months.
With
Okay. And
REITs,
this
you
is a
can.
little bit easier. And this will help you grow, because real estate always grows.
Yep.
And especially if you're putting your money into something that obviously you have a professional that's researched it, that, they can make some good decisions around. Good. Awesome. Next topic I want to get into with you. We're running out of time. I could probably talk to you for the next 3 hours, but I want to talk to you about investments in terms of RESPs and RRSPs. I have this one RSP account I've been putting money in like forever. I
Mhm.
don't see a ton of change in it. I just see that I'm putting money in it, and the bank grows it just a little bit here and there. Um, and I'm not really sure, where it's getting invested. So, what would be your recommendation for something like that?
Well, I mean, I think when people come to me with a similar situation like what you said, they don't really know where the money's going or what's going on. I think a lot of the time, we open up these accounts and maybe at one point you had a deep discussion with the advisor about, I'm not sure in how much of a hand you had in choosing the investments or not. Some people don't have much of a hand. The advisor does it. They don't know, they're kind of hands off.
Exactly. It was sort of like sorry to interrupt again. It was like a low, medium, high risk.
Yeah.
And really, that's really all there was to it. and I was a lot younger then, so I was just like, just give me whatever,
Yeah, whatever. Yeah,
just give me
yeah.
whatever.
Exactly. So I get that a lot, when it comes to even employer RRSPs, people kind of just get a new job, they pick this high, low, medium, and then they just leave it alone and never really see it again. I think it's important for you to pay attention though, Amir, in regards to what's in there, and either revisit it with that bank itself or talk to a financial professional like myself as well for some other options. Because remember, this is your retirement savings. And considering that you and I are both fairly still young and far away from retirement, we have a really long time horizon, but we want to make sure that that money's doing what it needs to do in that interim. Because if you're actually too conservative, Amir, that actually works against you, because you've had all this time to be more aggressive, which you should be right now because you're farther away. But because you haven't been paying attention, it could be sitting in some like low income bonds or something like that, where it's getting like 2% and you wouldn't even know because you don't revisit it. So I tell people, pay attention to their stuff and revisit their time horizon, because if you're further away from retirement, you actually want to be more aggressive right now.
Very cool. Okay, very good. Thank you for that. And now RESPs, we have a few of those. We sort of opened it up. I found these ones are pretty awesome, especially like it's cool to have kids, and you can put money under their name, and the government pays you money to put this money in. So
Absolutely.
Tell us about that one and the benefits around it. And is there right and wrong ways of investing this?
Yeah, so the RESP is great. I definitely recommend it for any parent that has a child, and even grandparents can open it for grandchildren as well. It doesn't even have to be the actual parent, but it stands for Registered Education Savings Plan. And essentially it's a way for you to have your money grow tax-free to save for your child's education. So you can put in up to 50,000, I believe, is the cap for the life of the plan. But basically, once you put in your money on a monthly basis, you can do lump sums, monthly, annually, whatever you want. The government will put in, I believe, up to 20% per month. And basically, you're going to put in your contribution. The government puts in some money too. And on top of that, together, the government's money plus your money gets invested in the market. So it gets interest from the market as well. Altogether, that accumulates and compounds over time and grows tax-free. So when your child is now ready to go to university or an apprenticeship, college, whatever they choose, then they're able to start to liquidate that money and use it for their education.
That's interesting that it's only $50,000, because anybody's gone to college and university, it's pretty expensive. I think I think you're gonna need a good $100,000. I don't know if there's any word on them increasing that at all, or is it?
Not that I know. I believe 50,000 is the max that you can put in at this point. There could be people that still over contribute, but I mean, realistically, I think the RESP is only one part of your portfolio for your kids you should have. You can also open up other type of savings account as well for them. Even life insurance, believe it or not, you can actually have a whole life policy. Open that up for your child as well. And the money within a whole life policy also grows tax-free. So participating whole life policies allow you to have cash-free growth as well, where you get dividends from the insurance company that get paid into the policy. And you can also access those dividends, which will be taxed at time of claim. But you can access basically income from the whole life policy to help fund kids' education, marriage, down payment of home. So there's tons of things you can do. I think an RESP is just one piece of the puzzle.
Awesome. So everybody out there is going to be watching these videos. If you're like me and you have a lot of work to do in a day and you can't really take time out and just really figure out all this information all in once, reach out to Nicole or your professional advisor and really get to know where your money's going. And especially if you're a self-employed person, make sure you have things in place, and somebody like Nicole or Nicole herself would be a fantastic resource to go to. We're going to have her information on here as always with all the professionals we meet. And again, in terms of real estate investment, if you'd like to reach out to her as well, go for it. And there's some cool products there. So Nicole, thank you so much for joining us today. And I hope we can pick your brain a little bit more down the road. Definitely. But it was really a pleasure to be able to sit down with you and chat with you today.
Thanks, Amir. Thanks for having me.
No worries. We'll see you next time.
All right. Take care.